talk about profiles. So there's two types of structures. You have your structure where price, let's say break structure, but then retraces deep inside of the range. This would be your supply and demand structure. This would be your supply and demand structure. And this is the structure that we're currently focusing on when it comes to your buy and sell models. And then on the other hand, you have your expansive structure, which would be more of a support and resistance structure where price does not retrace deep inside of your range. Price can find resistance at your support and resistance, be a high rejection point, or price could always retrace somewhere at your 50% line. And instead of price retracing all the way deep, like a supply and demand structure, price would retrace at your 50%. So these are the two types of profiles that we will be looking at. Okay, so let's mark our range. Previous range was this swing and this swing. This was our previous range. So now once price broke structure, this is our new low. And we're waiting to see if price does commit to going back inside the range. And this is not just a quick pullback for price to expand. Okay, price is committing back inside the range. So now this is our high. And you pull out your fib. And what are we waiting for? We're waiting for price to reach our discounted area. Why? Because the previous reaction was to an extreme area. So now we're waiting for another extreme reaction. And not only that, we're waiting for a entry signal. So we can go on the lower time frames and see how price reacts. So we can start our buy model. What happened here? Price did not retrace deep and rejected around the 50% line, which means this is a support and resistance structure. So now let's mark the previous low, the last low prior to the structure break, because this was the structure break right here. And let's see if price comes back inside of this range. Again, we're trading range to range. When price goes into an expansion, something like this, price is already too far gone. As far as if we get another bull candle and another bull candle and price is not showing us ranges, this is not a safe way to trade, because you could always get in a trade when price is rallying, but price will always, more than likely, especially trading Forex, will pull back. Price rejected at the range. So this might be a support and resistance structure again. So we need to pay attention to this high right here, unless price comes back inside the range and closes. Okay, price broke this high. So what do we have now? We abandon our previous range. And now we're focusing on this low right here and this high right here, seeing if price does come back inside of the range. And price came back inside of the range without any lower wick. That means price is committed. So we pull out our swing low, swing high. And we can go on the lower time frames. Go on the 15-minute. And look at how price is going to react in our extreme zone. Again, what we are waiting for here is for price to get down here, reject, and come back inside of the range. What happens when this happens? This gives us that first interaction. This would be our first interaction. That first interaction gives us a range. Once we have that range, we can mark that range and wait for price to break it. Once price breaks this range, you can start your buy model. What is your buy model? It's either consolidations going up, or it could always be few pullbacks. And other times, once price breaks this range, it just rips up and completely closes out the range. So this is what we are waiting for. And the rule as far as your time frame goes, you always want to go 1/8. That's always the golden rule. And if you watched any of my previous videos, I always go 1/8 or just a quarter, which is 1/4. 1/4 would be the highest, 1/8 would be the lowest. So we have our first interaction and a strong pullback to the bull side, and price came back inside of the range. So now this is our range. Let's make this golden. So once price breaks this level, you can start looking for your entries, whether it's your continuation setup. Once price reaches this level, you can get into a buy, get into a long position, and take it back to the other extreme, which is your premium. You can take this type of trade. So once price crosses this level, you are in a trade. You're not waiting for a close or anything. This is a continuation entry. Or you could wait for a price to break structure and then come back inside of the range for your return to origin, and then get in a buy here and obviously take your first TP right here and your second TP right here. So these are your options. Or you can wait for your second phase of your buy model. So let's say price break structure here and then starts another structure here. You can start looking for your support and resistance structure to take it higher, or you can wait for a deep retracement to take it higher, or you could always wait for an inducement. It all depends on your preference as far as the strategy that you like trading. But the easiest one to trade would be your continuation. So you see what happened here prior to the break? Let's zoom in. This is extremely important. Look what happened prior to price breaking your pullback from your first interaction. Price tried to trap traders by putting them in a wedge. By internal to internal trap, price did not break structure either way. This was a trap. So now that price broke this level, now you know that the buy model has started. And what are you anticipating? You are anticipating price to at least reach this level, if not completely break this level. So you had your return to origin here. Price is consolidating. Price has been consolidating in this entire area. So now that you have your consolidation marked, what you're waiting for is your entry. So once price leaves this level, you can take a continuation entry right here with your stop loss below your swing. Or you can wait for price to break structure and come back and retrace to the discount extreme micro level, or which you also have here, which is the highest probability trade, but a lot of time price might rip before this happening. So don't get really used to it. You have a liquidity level right here. You have three equal lows. You have an equal low right here, you have an equal low right here, and you have an equal low right here. And what price could do is stop hunt and end up at the extreme. So your TP, your first TP would always be the extreme, the other end of the extreme, which would be your premium extreme. So these are your three options as far as entry goes. Price broke structure right here, but then came for the pullback. Price is at your extreme of the micro and went for the stop hunt. Even though you had a deep retracement, just know your stop loss is always right here, so you're still safe. Let's see, price is almost at your TP. and price reached your TP. And as you can see, as far as your buy model goes, you had your stop hunt, you had your consolidation, price broke structure, consolidated again, and finished your target. Now here, price could either reverse from your extreme premium or could give you another consolidation and break above